In general, when the Mag 7 is doing well, when the world is very positive on technology stocks, nothing beats trading the FANG index. You've got to be trading it. Now, second to that is always going to be the NASDAQ, because NASDAQ is pretty much 65% technology. So it's basically the FANG plus consumer discretionary.
We're back in it. It seems like a little bit of light volume today.
Light, depending where you're looking. The theme now has shifted away from US elections for now. I think a lot of that is obviously priced, and we're actually focusing quite a bit on Europe for a change. There's quite a bit of volatility out in Europe, given what's happening in France in particular. That, as well as we've now, ECB central bank is talking about, 50 basis points being a live option for December meeting. So we'll do something in Europe, and then, at some point we'll revert back to the US. But yeah, there's definitely a bit of movement in Europe at the moment.
And in France, it's all about the budget, right? It's about passing a budget. And it's funny because we just kick the can down the road. We can't get everything in a row, so we just pass an amendment and raise the debt ceiling. But that's a little more serious in Europe.
It is and it isn't. It used to be. When I first started trading, there was an ironclad agreement in Europe that, we would always stick to the agreement of holding debt to GDP at a certain level. But what we've noticed since COVID is, of course, everyone relaxed the rules. We're now 4 years beyond COVID, and many countries are still not back to where they were pre-COVID. I mean, the likes of France are spending 6.5% debt to GDP per year. So no different to the US. The only difference is I suspect the money that's spent in the US is a lot more coordinated and directed. In Europe, we just subsidize things in a very bad way. So it used to be that, no, we do not spend beyond our means. Now it's a case of, well, if you don't spend beyond your means, you're going to fall behind. And we have Germany. I mean, they're at a governmental level. They've got an election coming up. So the issue is that people are just fed up with no spending in Europe. And I suspect next year is going to be more about Europe spending as opposed to this sort of sticking to a debt to GDP ratio. So I think Europe's going very much exactly the same way as the US. I think it's one to watch as a key theme for next year.
Today, I think we're going to talk about which index future to trade, right? We're going to look at some of the differences and how you might determine what trade. It seems pretty straightforward, but I'm looking at a chart you have up here. I love this chart.
I think the first thing to say is which index to trade. That's kind of how I've looked at this. And traditionally over the last, I'd say, almost 10 years, you wouldn't look anywhere but US indices as a trader, because what's the point? Nothing else really moves. Now, I mentioned to you previously that Europe now might open the fiscal taps next year. And if that's the case, well, I suspect you'll see a lot of money flowing away from US indices back towards Europe, because Europe historically is cheap relative to the US, and for good reason. Why would you invest your money in Europe? So let's now focus on the US, because that's the topic of today's discussion. Which index should you trade as a trader? And it depends. There's an expression you must learn and almost marry, is that you always want to be buying the outperformers and selling the underperformers. And what that means is that these all indices, they're all correlated to some degree. And so when markets are rallying, when we have a risk on sentiment, they're all going to rally. Now, in terms of the different sort of indices, what I've got here for you, it's again, this idea of a rebasing index to showcase to you that, in the real light blue, we've got the FANGs, okay, and that's the FANG index, and we can talk about what makes up this index. And if you compare that to sort of the more dark blue over here, that's the Russell. Now you can see at a performance level, since 2020, fine, Russell's up 80%, but FANGs are up 450%. Why? Right. Well, because the last 4 years has been all about this idea of FANGs and AI, and it's been all about technology stocks. It's important to stress that when these themes exist, when these fundamental drivers are there, trade the FANG index, trade the NASDAQ. Don't worry about the Russell. Yes, the Russell will go bid and will go off, but that's not where the opportunity scope is. And so that's the first theme to sort of bring to your attention, Tom, is that there is a time and a place to trade different indices. You don't want to just say, well, I'm a Russell trader, I trade Russell. No, trade the theme that's ultimately driving the biggest bang for buck. That's the way to look at it.
The reason why I love this chart is it's basically a percent change chart, essentially.
And I think the key takeaway, and this is kind of how you want to think about the indices in general, what you want to take away from it, and I'll kind of just highlight this. If you go to the start of 2023, look at that rally in the FANGs, 150% rally in a space of 3 quarters. At the same time, what's the Russell done? Nothing. What's the NASDAQ done? Well, the NASDAQ showcased, and as you said, yeah, trade the NASDAQ off of that. What's the S&P done? Sure, it's up 15%, but that's, as traders, not where we want to be playing. We want to be playing where the opportunity scope is. So that's why we look at it this way, is we want to make sure when there is a theme, we're trading the appropriate markets based on the theme. The way to think about the indices, and the way I always think about it, the most volatile. And when I say volatile, think in terms of what's the most sensitive to a theme. It's always going to be the FANG. Why? Because it's made up of 10 stocks. Okay. And yes, it's an equal weighted index, which does reduce the volatility somewhat. But in general, when the Mag 7 is doing well, when the world is very positive on technology stocks, nothing beats trading the FANG index. You've got to be trading it. Now, second to that, and also second in terms of volatility, is always going to be the NASDAQ, because NASDAQ is pretty much 65% technology. So it's basically the FANG plus consumer discretionary. Between consumer discretionary and FANGs, they make up about 80% of, the NASDAQ, right? And that's why there is that direct correlation between the two. In terms of the next best to trade, it's very much the S&P. Why? Well, because the S&P, again, does have a lot of the NASDAQ and it does have a lot of the technology stocks in, but it's more broad-based. It's 500 companies. It's not as volatile, of course, as the NASDAQ because it's a blend of many different types of companies. The S&P is kind of seen as the bellwether. That's the one that tracks both technology as well as the general economy very, very well. And then, of course, you've got Russell, which is small companies, small stocks, and the Dow Jones. And in that order, I would say you would have the most volatile or the most potential to move based on new themes versus the least likely to move, which is the Dow Jones. Dow Jones, very much price weighted, just big companies that don't really show much volatility. Of course, there are times where they're volatile, but a lot less because they are blue chip names. So that's a way to think about the indices. Now, there are key things that drive stocks, and I want to bring your attention to three of them because I'll show you this on a chart. That's interest rates and economic growth and corporate earnings. Between those three big macro drivers, ultimately the indices will move up and down. This is the playbook for trading indices.
That's probably the most comprehensive and succinct description of macro factors, what we should look out for, because it's easy to get lost in the stories. How do we interpret this? What markets are we looking at?
The reality is it's never one individual thing. You so often see on social media or when you read the Wall Street Journal, you'll see they'll say Fed expectations of interest rates are rising and therefore equities are selling. It's not that straightforward. I wish it was. Unfortunately, journalists are not financial analysts. Yes, interest rates is one piece of the puzzle. There's inflation, there's GDP, and it's all about if the Fed does move interest rates higher, what are the implications for inflation? There is nuance involved, and that's why you've always got to be careful reading newspapers, these macro factors that I showed you, assessing them all together. What you've got there in the orange is you've got 2-year yields. Okay, so think about that as interest rates. This is the expectations of interest rates, what markets think interest rates will be, starting 2 years from now. In the purple, we've got the NASDAQ. Now, why I've put NASDAQ is because if you go back to that discussion of what are the most sensitive and least sensitive, well, NASDAQ is going to be the most sensitive to interest rate changes or expectations of where interest rates are going. We go and look back at history. So we obviously, of course, look all the way back to 1999. In that cutting cycle that we saw, heading into the year 2000, of course, we had .com, etc., etc. We had that significant rally. And then, of course, we had the great collapse of everything. Interest rates collapsed. And we can see that NASDAQ gave up all that returns that it had in that 99 .com bubble. The point is that technology stocks are very, very sensitive to high interest rates, not interest rates going up. Typically what happens is when we get an interest rate cycle, you can see that over that period from 2004 to 2008, the NASDAQ returned 26, 27% over 3-4 years. That's insignificant. For a volatile index that's naturally volatile, that's a really poor underperformance. And if you go compare some other indices there, you'll see they perhaps perform better. Why did the NASDAQ underperform then? Well, because interest rates were moving higher. Were those interest rates so high that they created a problem for the NASDAQ? Well, obviously not. Otherwise, we wouldn't have had positive returns. And that's that key. It's that, yes, higher interest rates are problematic for technology stocks, but only if they lead to a destruction in growth and demand, i.e. GDP. In other words, if the Fed set interest rates so high to the point that it actually led to some form of a recession, then this NASDAQ would have been negative in terms of its return. Okay? And that's what I mean by it's not just one single macro factor. It's that macro factor. How does that influence demand? How does that influence inflation? How does that influence growth at the end of the day? Now, in a basic sense, if you want to think about this, and I'll show this to you on another chart, always think of in terms of interest rates in tandem with growth. Is the interest rate so high that it destroys growth or leads to negative growth? Yes or no? If it does, i.e. lead to a destruction in demand and growth, we'll get some form of a recession, and equity indices will always underperform in a recession. Now, if you look in recent past, going back to 2010, we had that recession. There's the financial crisis and the NASDAQ sold off. We can see the Fed cut interest rates very aggressively. They begun the process of quantitative easing. And what did we see? Well, we slowly saw, even though this was an average of around 1.4% growth over a period of 4 or 5 years, even though it was very sort of anemic growth relative to the long run average, we can see that that was enough for stocks. Okay, they rallied 580% over the course of the next, 8, 9 years. It's always a case of what does policy do ultimately in terms of growth expectations. If policy is too tight, you'll have lower growth expectations, which is not good for equities. If they're negative growth expectations, that's bad for equities. But if they outperform growth expectations, that's when we get this. You get the idea of what I'm getting at. COVID there, we had the recessionary fear. That's that move there. The Fed promised to do whatever it takes. They had the bazooka in terms of QE, and equity said, thank you. We then had a Fed that said, look, we need to hike 50, hike 50, hike 75. And all of a sudden equity said, whoa, what's going on here? Where's this going to stop? There was fear, there was panic, and eventually we bottomed out because the market realized that, well, look, that's the top for rates. It's not going any higher. So it's all about where those interest rates go, how they tug on ultimately growth expectations into the future. That's what drives the stocks. Okay. Now, one more chart and then we'll come back to the indexes. But this is important to understand and stress is that this is now a chart of long-term growth. Okay. So often I see people talking about, oh, we're going to hit a recession. Oh, it's overbought. Oh, valuations, blah, 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 blah. The reality is in the green, you've got current 1-year average growth expectations. In the purple, you've got 10-year growth expectations. And you can see prior to the financial crisis, what do growth expectations do? What did that purple line do? Well, it sank from around 2.3% all the way to around 1.1, 1.2%. In other words, even during a period where the Fed was doing unlimited quantitative easing and interest rates were zero bound, we really didn't have any growth coming out of the US. Now, yes, equities did rally quite extensively at that period. Why? Well, because we had some growth, but we also had this continual promise that we will keep rates at zero. Now, in an environment where you keep rates at zero, there's no risk ultimately to holding equities because if you go and hold bonds, you're going to get negative yield on that. And that's why equities did so well in that era. There just was no alternative to owning equities. If you see what's happened since COVID era, look what that purple line's done. Okay, we're back at 2.3%. We can see the green line is very much above long-term growth. And when you hear economists talking about the long-term growth expectations, for the US, it's somewhere around 2.2, 2.3%. Okay, so in other words, if we're growing above that, what that's telling us is the US economy is growing a lot better than is expected. That's why we are staging this rally. That's why the markets are so upbeat about what comes, particularly next year. The US government spending, if they're spending, we're going to see above average trend growth, and that's only going to be positive for stocks for 2025.
In light of that, I think of the new administration coming in. You have Elon Musk heading the Doge Group, right? Department of, I forget what it is, but accountability, basically, right? Yeah. We're gonna cut the budget. We're gonna, some people are calling for spending to go down. Does that affect that growth aspect? I know we're talking about government versus private equity, but if we're seeing that rates are maybe stable, does that affect growth estimations going forward?
If the Doge committee is more effective for every dollar of debt, and they can get better output as a result of every single dollar of debt. The reality is that's only going to ignite a rocket underneath not just the US economy, but in general stock market. This is now just doing a rebasing, looking at this year, and you can see the themes for this year, which is start of the year, we had higher inflation. What did equities do in that period? Well, Russell was pretty much flat. We were down 5% at one point. We were up 5%. But for all intents and purposes, for the Q1, equities were flat. They didn't move. Then all of a sudden, we started to see the weakening of the data. May, June, July, leading up to that really bad unemployment rate number, we started seeing weakening of the data. The real economy, i.e. the Russell, underperformed. What did NASDAQ and S&P do? Outperform. Why? Because we want to own the Mag 7. If they're going to start a cutting cycle anytime soon, own the good stuff, not the weak stuff. All of a sudden, really bad non-farms print. What happens? Everything sold off. Russell back to flat in the year. NASDAQ, S&P only up 5-6% in the year. This year for equity indices only started August. What happened then? Powell signaled the pivot. They cut 50 in September, and that's where your returns have come from. Not just a small cutting cycle, not a regular cutting cycle, but an aggressive cutting cycle. That's what the current price is reflecting. And that's why I said, if they were to pause in December, okay, equity indices are baking in a lot of more cuts coming. They're not expecting any kind of a pause in December. So since Trump came in, that is the time and the only time Russell became good to trade. Why? Well, because Trump wants to get rid of a lot of red tape. He wants to really stimulate the economy, create a lot of subsidies. And that's always going to be better for small companies versus the big companies. Okay, so that's kind of the takeaway from it. You got to pick your poison. But like I said, trade the good stuff. NASDAQ, S&P, yes, there's more than enough to do there. There is times when you want to trade the Russell, but that's not a playbook that's regularly used.
You made a point about news focusing on one aspect and they're not seeing the whole picture. So true. And I think they're in a different business, right? They're trying to grab your 30 seconds of attention. Nope, not as traders. We need to do a little more thoughtful work. So thanks again, Brannigan, for coming on.
Appreciate that, Tom. Thank you very much, everyone.
This presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader, LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.